A secret White House meeting just exposed an unthinkable crisis is imminent. I'm Steve Van Metre. The payback period looms and fears of stagnation rise. Retail titans warned of trade war chaos, and as you're about to see, the real crisis is just starting. Now let's over to CBS, where we picked today's story up with a headline as Walmart Target CEOs privately warned Trump tariffs could lead to empty shelves soon. But that's only part of the problem, because what they're really warning about is prices are going to go higher, and right now U.S. consumers aren't in a position to afford them. Chief executives of Walmart and Target privately warned President Trump this week that his sweeping tariff policy could disrupt supply chains and lead to empty shelves in the coming weeks. Even the CEO of Home Depot was present at Monday's closed-door meeting as retail executives were warning Mr. Trump about his policies, and yet they declined to make any public comments, and for good reason, because they didn't want to be seen as going against the policies of the President of the United States. But the warnings they're making are very clear. Shelves are soon going to start emptying at the same time. Prices are set to rise. But the real issue here, it's all about the labor market. And we talked about this yesterday, as many executives aren't ready to lay people off, but they're building lists, because if things get worse, they're going to be sending a lot of employees to the unemployment line. And when that happens, it's going to be all hell is going to break loose in the U.S. economy. And we had a productive meeting with President Trump and his team and appreciated the opportunity to share our insights. The two retailers have publicly warned that Mr. Trump's tariffs could lead to higher prices. And weeks after Mr. Trump's election win, Walmart CFO John Rainey said, "We never want to raise prices, but there'll probably be cases where prices go up for consumers, and the expectation is that this is coming in May, because we know there's a lot of ships inbound for U.S. ports right now that are going to arrive and be subject to the tariffs, and we know that those prices are going to be passed right on to consumers." Now, I want to know from you, are you already seeing price hikes due to the tariffs? If you are, weigh in the comments below what you're buying, where you're seeing it at. Because last month, Target CEO Brian Cornell said the consumer will likely see price increases over the next couple of days from tariffs planned on imports from Mexico, noting that Target heavily relies on Mexican produce to stock its grocery shelves in the winter. So this is another problem for consumers. Not only are they going to see prices go up across the board, but on groceries as well. And this is a big problem, because when you think about the pain that consumers are facing right now, is their incomes aren't keeping pace. And what we're seeing is that costs for groceries are going to go up, and that means it's going to have an immediate impact on consumer budgets, and that's going to translate into less discretionary spending on the other side of the economy. And again, it comes back to what we've been hearing from executives. If demand doesn't pick up, we're willing to keep employees for now, but we're not going to keep them forever. As we take a look at the Consumer Price Index in blue against total income for production and non-supervisory employees in red, both on a year-over-year rate of change. And again, we go back to the 80s, and what do we see? Inflation on the rise. But the problem is employers do not pass it on to their employees. You see incomes peak, they roll over, it heads down right into the 91 recession. You see the same thing going in the dot-com bubble, except incomes were trending quite strongly at the time. But what happened is inflation took off. It wasn't passed on to employees. Incomes decelerated right into the dot-com bubble. Going into the global financial crisis, energy prices led the increase in the CPI higher. At the same time, income growth started to decelerate right into the financial crisis. And we talked about the other day, why are delinquency rates rising? And now you're seeing why firsthand. Prices are going up, and at the same time, income growth likely to further slow. And that's what we're expecting to see in the CPI in the months to come, is that there's going to be a huge increase. At the same time, we're going to see take-home pays likely unchanged, if anything else, decelerating to the downside. As we look at the Consumer Price Index against real retail sales in red, and this is what executives are warning about, that they see demand going down, and it makes perfect sense, because if take-home pay is largely unchanged but the cost of goods goes higher, well, it means your check can't go as far and consumers are forced to spend less. And the evidence of this is extremely clear. Let's go back to the dot-com bubble, and what do we see in late 1999? Real retail sales accelerating to the downside, enters a contraction. At the same time, inflation going higher, validating what we see in the income data, suggesting that consumers could not afford higher prices, and so they started spending less. We see that happening going into the global financial crisis as rising energy prices cut the discretionary side of the economy. Retail sales plunged, stayed sideways around the zero mark before they entered a massive contraction. And look what happened around 2022. Finally, incomes were not keeping pace. And what did we see? Consumers said, look, we can't afford to keep spending at the rate we were. Real retail sales were largely zero over the last 3 years. And look at this, inflation now set to go higher. Retailers saying, Mr. Trump, your policies are going to crush demand. And when that happens, the next step is we're going to be forced to lay people off. We don't have a choice here. And yet import duties have rattled markets in recent weeks and prompted fears about rising consumer prices, slower economic growth, and supply chain shortfalls. And that's exactly what stagnation is when you get rising prices and slowing economic growth. And the problem in this case is monetary policy doesn't work. But throughout history, every time we see this happen, the economy goes into recession. And that's the best case scenario, because if we look at the health of the U.S. banking system in terms of the regional banks, we look at all the debt and the delinquencies that are starting to build, we're facing an all-out financial crisis. The Trump administration has considered forming a workshop group to handle any strains on supply chains caused by Chinese tariffs, and it could be too little too late. But something that shouldn't be rattling is your trading account. Check this out. We put this trade back on the 21st to our CTA Timer Pro subscribers on DBA. That's agricultural commodities. We told them to buy at the open right here because we saw machine positioning was about to buy as it was holding its 6-month volume profile, and it's taken off. It's up over 12%. Now stay tuned to the end of the show for more information, or check out the links in the description below. Grab your coupon code for your free 30-day free trial. Start trading against the machines and win just like our subscribers. As Trump sees trade deals getting done in 3 to 4 weeks, the problem is the economy may not hold out for 3 to 4 weeks. And that's what the executives, a lot of these retail companies, went to the White House to tell the president, to say, look, your policies are causing all-out chaos and could plunge us right into the next crisis. I'll be finished, Trump said. Now, some countries may come back and ask for an adjustment, and I'll consider that, but I'll basically be, with great knowledge, setting ready. And Trump told reporters today that he's getting along very well with Japan, and the agreement is very close. The problem is we need these agreements, and we need them fast. And again, it's not just about the fact that shelves are about to dry up and go empty. It's about the fact that prices are set to rise, that consumers can't afford them, and that pushes us right into stagflation. The question remains is how long can companies hang on before they're forced to lay off? Trump in the interview also pushed back on reports that Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick convinced him to delay his reciprocal tariffs, and said, quote, he wasn't worried about the turmoil on the bond and equity markets that greeted his higher duties. And yes, they largely probably did push back, and it makes sense, because when you put massive trade barriers up and you grind trade to a halt, well, you take the entire global economy and you push it right over the edge into the point where we could head right into a recession. Now, the real issue is we were already getting very close to the edge to begin with, and we just need something to give us the nudge. And now the problem is, with global trade drying up, what we're finding out is we're going to see a massive amount of layoffs, and they're already starting in China. Our export orders disappeared as Chinese factories are shutting down and laying off workers. What is now effectively a U.S.-China trade embargo remains in place. The U.S. economy could, quote, see shortages on shelves within weeks and or price increases. And then, even if there is a tariff U-turn, logistics would be overwhelmed. And there's no doubt about that. They would be completely overwhelmed. But that's not the issue. The issue is prices going up at a time when paychecks aren't rising. When that happens, again, demand goes down. And as demand goes down, what we find out is also a decrease in demand for labor. And because, stated simply, the first country that hits max pain point will also be the one that loses the trade war. And that's the case we've been making from the beginning, that this is an economic game of chicken whose economy reigns supreme. And right now, many people said it was China that could sustain, but based on the latest data, it might be the case that China is the first to break. The question is, again, we come back to these retail titans. Why did they go to the White House? To warn President Trump, if this trade war doesn't end and end soon, it's going to be all-out chaos here at home. And there were several sectors of China's economy that are now already in deep pain as various supply chains are seeing the economic impact of the trade war. And Financial Times notes that factories across China have been shutting down and furloughing workers as a trade war unleashed by U.S. President Donald Trump dries up orders for products ranging from jeans to home appliances. And while China isn't a major exporter to the U.S. like they used to be, they do export things through other countries that get to the United States. And what's happening right now is demand there is plunging. We're seeing factories shut down. We're seeing workers go on furlough. And this is all going to impact the Chinese economy in a major way. And again, could be the tipping point, plunges them right into a recession. Now, the issue with China is we noted they were already going into a recession. And the problem is that their property sector was highly leveraged. And that means it could margin call the banking system there and plunge them into an all-out financial crisis. China doesn't have a whole lot of moves here. They could stimulate, they could lower interest rates, they could devalue the yuan. They may have to do all of the above. We'll find out soon enough. But the question is, whose economy can last the longest? I want to know from you. Weigh in the comments, who wins this, the U.S. or China, or is it mutually assured destruction? Because about 15% of all Chinese exports last year went to the U.S. But here's the real issue is that China is increasingly transshipping billions of goods to the U.S. using untariffed venues such as Vietnam. So they've gotten around it, and that's the issue. Just keep in mind, just because it may not be entirely made in China doesn't mean it has parts in it that are from China. The problem is for China that unlike the U.S., there's no centralized social safety net. So the longer the trade war continues and the more workers are furloughed than fired, the progressively faster the situation will get. Because when we talk about whose economy is the strongest, it all comes back to the labor market. Because as long as people have jobs and are spending in the economy, you can keep it running. So what we're seeing now is if a lot of Chinese workers lose their jobs, and that's what we're getting the indication is happening right now, that means the China's economy could be the first to collapse and drive them back to the negotiating table to make a great deal. But on the other side of the story, if they hold out, well, what we're going to find out starting next month is that employers may not be willing to hold on here. And if they start laying off, watch out. It's going to be chaos on both sides. And hopefully the U.S. will change its policies, because if it doesn't, millions will end up unemployed and with no short-term welfare state benefits to hold them over until the economy recovers. It could get very ugly, just as Trump expects it will. And yes, that's exactly what he's hoping, is that the U.S. economy can outlast China's. The question is, can we, will we? We don't know. But based on the fact we're seeing the CEOs from Walmart, Target, and Home Depot going to the White House to warn President Trump, tells us that we're not far off for our own crisis. And yet food giants warn of more pain for consumers as trade war bites. And again, we talk about the problem of rising food prices because this hits the core spending of a household. Again, they've got rent, they've got energy, and they've got food. So if food prices are going up at the same time prices on the discretionary side are going up, what it means is even less money to spend in the real economy. That means more workers are going to face getting their hours cut. Others are going to lose their jobs, and all of that lack of spending and income is going to reverberate right through the U.S. economy. In fact, we're already seeing it. As Southwest Airlines CEO notes that the U.S. airline industry is already in a recession. Noting demand for domestic leisure travel has dropped more than he's ever seen outside the pandemic, what we see is the U.S. economic contraction is now in full swing, at least in the U.S. airline industry. The CEO said his company expects second quarter revenue to fall by 6 percentage points, following a 3-point decline in the first 3 months. So what does that mean is going to happen, at least in terms of Southwest? They're going to start cutting flights, and that means they're going to cut hours. That means they're going to cut jobs. So you can see this all happening in real time. And again, this is what retailers and executives are warning about. They're saying, look, Mr. President, we may not have 3 or 4 more weeks, and you better get this done, because if you don't, what's going to happen is there's going to be mass layoffs here at home. When consumers are uncertain, they pull back, and consumers can immediately stop spending. And that is the fear that's going to show up in the data here in the weeks to come, is that when the tariffs impact pricing, that people are going to stop spending. Now, I want to know from you, are you going to stop spending? Have you stopped spending? Or are you going to keep spending at your old pace regardless of where prices go? Weigh in the comments. I'd love to hear from you. Because China may exempt some U.S. goods from tariffs as costs rise. And now what we're starting to see is, as countries said that we're going to fight this to the end, they're facing extreme economic pain in the realization that perhaps you can't just tariff everything. China's government is considering suspending its 125% tariff on some U.S. imports as the economic costs of the tit-for-tat trade war weigh heavily on certain industries. And authorities are considering removing additional levies for things like medical equipment and industrial chemicals. At the same time, Chinese carriers of plane leases don't own all their aircraft and pay leasing fees to third-party companies to use jets, payments that would have become financially ruinous with additional tariff. So what we're seeing is these tariffs are causing major pain, and what that means is countries are going to start to back off. At some point, when they start to see the labor market unwind, they're going to come back to the negotiating table, but the problem is it may be too late. A couple of our member companies have reported that even within last week, they had a few shipments that were imported that did not have tariffs levied on them. It does look like both governments are looking carefully and don't want to stop trade overall. So that's very interesting, despite the fact that we see in the news that we hear from the White House that there are all these levies, that some things may be coming through without them. Again, it's just a sign that there's some realization going on here. You see panic at the top level of corporate executives trying to tell the White House, look, this rise in prices from the tariffs, it's not sustainable. Consumers can't afford them. And look, we're going to be forced to lay people off if demand gets crushed, and that's starting to be the base case as people on both sides of the trade war start to realize that this may just end in mutually assured destruction. But despite the global economy facing a massive inflection point that could cause it to crumble down, doesn't mean your trading account has to go with it, because we told our CTA Timer Pro subscribers over the weekend to buy DBA, that's agricultural commodities, on the open at 421. Here you see the note, same setup as a previous trade note, buy the open with an upside target, and we told them to keep their stops tight, and they have taken off like a rocket. Now, how do we do this each and every day? We look at the machine positioning across the broad equity, bond, currency, and commodity markets, and we've overlaid the historical data in this. So we back tested it, and this shows up right in our hot list. But you get, in addition to the hot list, you get all the positioning across all of those securities. And here's the best part, you get the daily report, you get all the signals, but I review all the signals and give you my opinions on the best trades to take. I give you risk control levels, a full tracking of all open trades and returns, a weekly update. And here's the best part, we're so confident that you can make money trading our report that we want your first 30 days to be on me. That's right, grab the links in the description below. Be sure to use your coupon code to grab your free 30-day free trial and start learning how to trade against machines and win. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.